This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, before we put into practice some of the basic concepts of inheritance tax that we saw in our first lecture together, time just to go back over and look at those basic concepts that we didn't deal with in our first lecture together, and also then add a few more bits of detail in. What we'll then be able to do is, as we said, to practice those newfound techniques. The first point that we saw was that IHT usually arises just in one circumstance. It usually, now I'm not saying here that it always, but that it usually arises only on the death of the taxpayer. And at that point, IHT became payable not just on one transfer, the content of the chargeable estate at death, what the individual still owned in net asset value terms at the date of death. But what we also saw was that firstly, what would become chargeable were actually lifetime transfers that had been made, but only within a set period, which I'm sure you recall well, was those made within the 7 years of death. Any transfers that were made before that point in time, 7 years before the date of death, will not now be chargeable as a result of the death of the taxpayer. Only those transfers made within the 7 years of death. What we haven't yet seen or discussed in our first lecture is the labels that we apply to those transfers. That we'll talk about in just a little while. What, of course, would also then become chargeable would be the chargeable estate at death. That chargeable estate at the date of death. Again, as we said, essentially a listing exercise, listing out the assets held by the taxpayer at the date of death, where one or two little valuation rules might be applicable. Getting the chargeable estate, which was the net asset value, so we were able to deduct again any allowable debts and liabilities due at the date of death from the value of the assets held within the chargeable estate. And thus we got that chargeable estate. So there were two computations to prepare. Firstly, the lifetime transfers that become chargeable on death, and secondly, the chargeable estate at the date of death. Now what we discovered was that IHT would firstly be chargeable at a nil rate band, the nil rate band. IHT is chargeable firstly at a nil rate within that nil rate band, given on your rates and allowances page, of course, of £325,000. And because we've just seen the pecking order in which these computations are prepared, it is firstly going to be applied to those lifetime transfers that have indeed fallen within the 7 years of the date of death. Only if those lifetime transfers in that previous 7-year period, only if they accumulate to less than a total of £325,000, would then any available balance of that nil rate band be applicable against the estate at death, the chargeable estate at the date of death. So, IHT chargeable firstly at the nil rate. The nil rate band of £325,000 is applied firstly to lifetime transfers here, and then, if there is any remaining nil rate band is applied to the death estate, that chargeable estate at death. Now, in terms of what goes to those computations, we want the chargeable transfers. Now, the basis of valuing a transfer is to compute, firstly, what I've already underlined here and will again, the transfer of value. Now, normally, when an asset is gifted, whether it be in lifetime or on death, you would take that transfer of value as being what it's worth, the market value. But we saw, of course, that the basic concept of the transfer of value is not the market value at the date of death, but it is the transfer of value is the loss to the estate of the donor, the diminution in value of the estate of the donor. put again in terms of the computations we do, it is simply the difference between what did the taxpayer have before the transfer and what did the taxpayer have after the transfer. And that difference between the value of the estate before and after the transfer is the transfer of value. Now again, 9 times out of 10, that's going to be the market value of that asset. But we learned that with some assets, most specifically shares in unquoted companies, that we had to compute that transfer of value by very specifically looking at what was held before and what was held after the transfer to compute the transfer of value. Again, make sure you've revised back on that most important concept before we go any further. But the amount of transfer, again already underlined here, chargeable, the chargeable transfer as we will know it, the chargeable transfer, chargeable to IHT, is then after deducting exemptions. There are various exemptions that may be deducted, as that note tells you there, from the transfer of value to compute the chargeable transfer. Now then, there's only one exemption that we have seen so far towards the end of our previous lecture, and that was the spouse/civil partner exemption, where any transfers to your spouse or civil partner there would be exempt. Again, the concept of IHT was it becomes chargeable when basically assets pass from one generation to another. Transfers between spouses or civil partners are exempt. There is no chargeability there. So the spouse or civil partner exemption applies to both lifetime transfers and transfers on death. So whether you make a transfer in lifetime to your spouse or you leave all or a part of your estate to your spouse, all of those are covered by that exemption. So both lifetime and transfers on death. But there are also specific exemptions that apply to lifetime transfers only. Now is not the time to concentrate on that specific area of exemption. That comes up in our later notes and a later lecture. So we'll be dealing with that. But what we need to know is that when we do some basic computations, as we will in this lecture, the figures that we're including in these computations, whether we're talking in terms of the lifetime transfers made within the 7 years of death, or whether we're talking about the chargeable estate at death, the figures that we're talking about in valuation terms on assets is the chargeable transfer. And that is the transfer of value less any exemptions. Only one of which, as we said, we know at the moment, and that is your spouse exemption there. So, just winding back, what we have simply referred to as lifetime transfers actually now in more detail come in 3 forms. Well, one we've just been talking about, exempt transfers. Transfers to your spouse or civil partner, however much the value may be, it doesn't matter, any such transfers are fully exempt there. So those are not going to be chargeable. Not when made, not on death. Now I say there not when made or not on death. All we're aware of is that IHT usually arises on the death of the taxpayer. And we've seen that 2 computations would be required. We'll be looking at and dealing with the practice of those computations, as I say, a little later. But those computations were the lifetime transfers chargeable on death, i.e. those made within the 7 years of the date of death, and the chargeable estate at death itself. But those lifetime transfers then, if not exempt, will come in either of 2 forms. I'll pick up this one, the third on this list, CLT. That stands for, you may wish to note it now, chargeable lifetime transfer. It's a term we're going to continue to use in future lectures, but I'm introducing this label to you now. A CLT is a chargeable lifetime transfer. Now that is telling you something. It is telling you that that CLT is both chargeable in lifetime, i.e. when made, as well as being chargeable on death. Only, of course, on death if that CLT was made within the 7 years of the date of death. So what are these CLTs to begin with? They are transfers into a trust. Now, you do not have to know anything about trusts in relation to our particular syllabus. Look upon trust as a separate taxable person. What an individual is doing, either in lifetime or on death, here we're talking about lifetime transfers, transfers into trust in lifetime. They, the person who makes the transfer into the trust, is known as the settlor. The settlor. S-E-T-T-L-O-R. The settlor. The individual who makes a transfer into a trust. The trust is a separate taxable person, and it is run by trustees. Usually the settlor will be the first named such trustee of that trust. So the individual is transferring property out of their estate to a separate taxable person, the trust. The trust is operated by the trustees. Those trustees include the original settlor, the transferor here, as well as various other individuals, no doubt one of which would be the legal representative, the solicitor of that particular individual. These transfers into trust represent, as we're calling them, chargeable lifetime transfers. And what it means is there's going to be two occasions, or possibly two occasions of charge. One, for sure, when made. Those computations on CLTs are not an issue for this lecture. That's a separate area to be dealt with later on. But if you saw in a list of lifetime transfers made by an individual the following: a transfer to a spouse or civil partner, you would label that, as it were on your question page, exempt transfer. Never chargeable. Not when made, not on death. It is exempt. Absolutely exempt. You then see a further transfer into a trust. That you can then label CLT. And what that will have as a consequence is the requirement to include it, firstly, in a separate computation that we have not yet mentioned and will be dealing with in a later lecture. That is lifetime transfers chargeable when made. So it throws up the possibility, as was actually, although we didn't discuss this in our first lecture, it was within the notes that you would have read within that first lecture, where we had here a note in that introduction. We didn't discuss it in the first lecture, we just concentrated on the basics. But it says that in addition, there are also some transfers made in lifetime, transfers into trust, that will generate immediate chargeability to IHT, as well as chargeability on death. So this is the first time we've discussed it in the lecture, but you will have read that, I hope, since last time. So going back now to our notes here, all I am saying at this point is in a list of transfers, transfer to spouse or civil partner, exempt. No chargeability to IHT, that amount will be ignored, whether in lifetime or on death. Transfer into a trust, if made in lifetime rather than out of the death estate, we label it CLT, and that will require two IHT computations to be prepared. One of which, as I keep saying, we have not yet discussed, but we will be discussing and dealing with in detail in a later lecture, lifetime transfers chargeable when made. What we have been discussing so far is simply those transfers that are chargeable on death. What it will mean is if there was a CLT and that CLT fell within 7 years of the date of death, that not only would you have charged it when it was made, but there then may be additional tax to pay as a result of the death of the taxpayer. Again, the workings of which, the concepts of which, are not for now, they are for a later lecture. Any other transfers, and this represents the vast majority of transfers that you would ever see within an exam question, are known as PETs. There's a lovely acronym, PETs, a P-E-T. What does that PET stand for? It is a potentially exempt transfer. A potentially exempt transfer. And it is that type of lifetime transfer that we have been discussing in the limited amount of the notes that we've seen so far. What we have, again, hopefully learned from our first lecture is that when a transfer is made in lifetime, there was initially no chargeability to IHT, other than we know now on a CLT. But on all these others, potentially exempt transfer, it means that in lifetime, no IHT is payable. And it is potentially exempt. There's only one thing that would cause that transfer, potentially exempt when made, to become chargeable is as a result of the death of the taxpayer within 7 years. If the taxpayer lives for more than 7 years until the date of death, what was potentially exempt when made becomes exempt 7 years after it was made. As we said in our first lecture, the only transfers, lifetime transfers that become chargeable as a result of the death of the taxpayer are those made within the 7 years of the date of death. And if we go back, therefore, to this lecture's introduction, where we stated that IHT usually arises on the death of the taxpayer, only on the death of the taxpayer, we know now that the exception to that is when we have transfers into trust made in lifetime, because they represent, as the name indicates, lifetime transfers chargeable when made. So there is IHT to compute at that point in time. But when you die, what we now can see is that any lifetime transfers made within the 7 years of the death become chargeable. And that would include CLTs, where, don't worry, we're not going to get a double hit here. We said, and it still stands true, that the lifetime transfer was chargeable when made and now becomes chargeable on death. But it is only any additional tax, if any, that would become chargeable and payable. Only any additional tax, i.e. against the charge that arises on death, we will credit back any amount of lifetime tax that you have already paid. The workings of that, again, for a later lecture, not for now. The transfers that we didn't know the name of, that we discussed in our first lecture, you now know the name of. They are potentially exempt transfers. There was no chargeability when made. Live for 7 years, they will never be chargeable. But if you die within 7 years of those lifetime transfers, then those potentially exempt transfers, actually, because you died within 7 years, do not become exempt. They are chargeable, but only as a result of the death of the taxpayer within 7 years of death. And at that point, there is a single charge to IHT that needs to be computed. This is the type of transfer we have been discussing, and it is the only type of transfer that you're going to see in this lecture, until we get through as a later section in these notes and these lectures to deal with those lifetime transfers, those CLTs, chargeable when made. It's going back, therefore, to the statements of these transfers. Exempt transfers, as we know, spouse, civil partner. Transfers into a trust are the only examples of CLTs that we will see. And basically pets are any other transfers. Any other transfers to individuals that you make in lifetime. Now, the typical ones, again, that you are going to see will be to members of your family other than your spouse or civil partner, other members of the family. So again, any other transfers? Any other transfers there? We're talking about, we will see transfers, of course, the most likely to your children, to your sons and to your daughters, to your grandchildren, to nieces and nephews there, members of the family. It could, of course, be to other individual family friends that you make such gifts in lifetime, if you so choose. So, exempt transfers to spouse or civil partner, whatever it is, whenever it is. CLTs, purely in lifetime, transfers into a trust, and everything else is a potentially exempt transfer there. So now we know those types of transfer. What we have done, of course, then is to set up the idea that eventually, by the end of this chapter, you will be able to deal with those transfers that were chargeable in lifetime, and again on death, if death is within 7 years of the date of that CLT, those CLTs, those transfers into trust. You will also be able to deal with any other transfers that become chargeable on death, the pets, but only if made within the 7 years of the date of death. Transfers to spouse or civil partner, whether made in lifetime or made on death, they are exempt there. Okay. With that, therefore, introduction, let's just go back to our notes now. We had got as far in our previous discussions as the death estate. We had again identified what would be included within it, all of your assets less any debts or liabilities due at the date of death there, and we mentioned one or two specific valuation rules to apply. We also stated, of course, that bequests would be exempt to IHT if made to your spouse or civil partner. We now know that that is true whether, as we'll focus on here, those transfers are within lifetime or whether indeed they are on death. And what we referred to is, of course, then, when we come to compute the charge to IHT, is that we have, again, on death, either of two rates to apply. We have a nil rate band. And we've got to look at the available nil rate band is deducted from the value of the chargeable estate. The nil rate band is £325,000 in 2019-20, and as we said last time, has been so, of course, for a very long time. But the available nil rate band to go against your chargeable estate is your £325,000 reduced by the value of any lifetime chargeable transfers made by the deceased in the 7 years before death. We now know that those transfers would include both pets that now become chargeable for the one and only time, and CLTs that may now become chargeable to additional tax. We have to deal with them. There's no may about that. We have to deal with them. We have to include them in our computation. But it may be that there is no additional tax to pay. The amount we paid in lifetime is sufficient to cover any charge that arose on death. Once you have used up your nil rate band, applied, remember, in order, firstly from lifetime transfers, and if there's more than one of them, we spoke about the idea, and we will see soon, the idea of maybe you made a transfer 8 years before the date of death to sons, daughters, nieces, nephews, friends there, i.e. these are pets. If it was 8 years before the date of death, it's a pet, potentially exempt transfer. You die 8 years later, you've lived for at least 7 years, that is exempt. It will not be included now on any IHT computation. But you then made a transfer 6 years before the date of death, 4 years before the date of death, and finally 2 years before the date of death. So within the 7 years before the date of death, there are 3 transfers, going back to the earliest first, 6 years before death, 4 years before, and 2 years before death. How do we apply the nil rate band? On a first in, first out basis, as it were, there. So we go back to the transfer that was 6 years before the date of death, the earliest within the 7 years of the date of death, and it would be chargeable first. If that was £300,000 with a £325,000 nil rate band, all of that 300,000 chargeable transfer figure is covered by your nil rate band. So no tax to pay on it. If we had another one, 4 years prior to the date of death, of say £100,000, we've already used 300 of the 325 nil rate band, so how much would be left? 25,000. So this transfer of 100,000 made 4 years before the date of death would be split into 2 parts in your IHT computation. The first 25,000 using up the remaining part of the 325 nil rate band, 25,000 is at nil. 75,000 would then be chargeable at 40%, as we move there on death from the nil rate band to that 40% rate of taxation there. At that point, you've now got 6 years ago, £300,000 chargeable transfer, covered entirely by the nil rate band, no tax to pay. 4 years ago, 100,000, 25,000 at nil, that's used up the balance of the nil rate band, 75,000 at 40%. That therefore, 75,000 at 40 is what? £30,000 tax to pay. 2 years prior to the date of death, there was another £100,000 transfer that was made. This one, of course, is fully chargeable at the 40% rate. By now, all of that nil rate band has been used up. There is no further available nil rate band, and that means that the entire 100,000 of this transfer 2 years prior to the date of death is taxable at your normal death rate of 40%. So £40,000 tax would be payable there. And what that would also mean is that if now all of your nil rate band has been used on lifetime transfers, there is nothing left of that nil rate band to then set against your chargeable estate at death, meaning that all of the chargeable estate will be taxed at 40%. All of the chargeable estate would then be taxed at 40%. The nil rate band was fully used on those lifetime transfers. And that's what we've seen here, that the available nil rate band, 325,000, reduced by the value of any lifetime transfers chargeable there, made by the deceased in the 7 years before the death. The balance of the estate, here in my example that we just talked through, all of that estate now would be taxed at 40%. Okay. Now we've mentioned and we've now gone through the application of that nil rate band. We mentioned that back in the first lecture. What we have had, but only in recent years, is another nil rate band, so we as taxpayers will be very grateful for this, known as you'll see in this note here, that for individuals who die from the 6th of April 17, again in our examination, we will see a taxpayer dying during the 1920 tax year there, for which, again, our legislation is relevant. That for those who have died since the 6th of April 17, there is an additional residence nil rate band, which for our tax year 1920 is £150,000 residence nil rate band, When it was first introduced, it was introduced at lower rates in 1718, went up in 1819, now gone up to 150,000 in 1920. The only figure we need to know is 150,000, and you don't even have to remember it, because that, again, is provided to you on your rates and allowances page information within the examination. So we've got 150,000 residence nil rate band. Now then, the rules. The residence nil rate band is only available where a main residence is held within the death estate and is inherited by, it is gifted to, direct descendants, i.e. your kids or your grandchildren, a child, the children, a mix of children and grandchildren, whatever it might be. If you leave that main residence to anybody else, then that is not going to benefit from the residence nil rate band. Typically nieces, nephews there, people of that nature, cousins, whatever it might be. So this residence nil rate band, £150,000, and it is for deaths in 1920 tax year, that is only available where a main residence is held. And to help us here, the examiner has stated that a question will make it clear if the residence nil rate band is available. Therefore, you should assume that the residence nil rate band is only available if there is mention of a main residence. So that term has to be within the question, that the individual within their death estate held a main residence. That main residence, that language used, indicates that the residence nil rate band is then available. That, of course, only being available if the transfer of it, the bequest that you make on death there, you gift that to a direct descendant, either a child or a grandchild or combination of children and or grandchildren, whatever it might be. Make sure that we know those rules. The value of that main residence is, as we saw as a valuation rule at the end of last time and at the top of this page, after deducting any repayment mortgage or interest-only mortgage that is secured on that property. So it's that net after deduction of mortgage value that we're talking in terms of. That would be the chargeable amount within the estate. It is that figure that is therefore eligible for this residence nil rate band. If, of course, the main residence is valued after deduction of the mortgage at less than the available residence nil rate band, basically again using the 1920 tax year rate, it's less than £150,000, then of course the residence nil rate band is reduced to the value of the residence. If we had a property that was worth £200,000 that had an £80,000 mortgage against it, secured as it would be upon it, then the net value of that property within your death estate is only £120,000. Therefore, you've got 150,000 residence nil rate band available. Your main residence, as it would be labelled within the question, is 120,000. So you use £120,000 worth of residence nil rate band. You can't have 150 and use the extra 30 against any other assets. So it's going to be the lower of that net value of that main residence, or 150,000 maximum. Now we'll be dealing with other issues that pertain to these particular nil rate bands, again, a little bit later in our study. So I'll be returning to that particular issue. But for the moment, all I need you to know is how to deal with your basic nil rate band, and if applicable, if within the death estate there is a main residence that is left to a direct descendant, then that is eligible for your residence nil rate band. And it would be applied specifically against and only against that main residence. So it's effectively being used first, before then any of your available, if there is any, available normal nil rate band what's left of your 325,000 normal nil rate band, that would come in afterwards and go against the value of any remaining part of the estate, including any other part of the value of your main residence. Clearly, if your main residence had a net value of 200,000, then only 150,000 residence nil rate band would be available. That would still leave 50,000 still chargeable as a part of your chargeable estate, and therefore that would be taxable in the normal way. Again, of course, only after deducting any nil rate band, any of your 325 that still remains after having firstly dealt with, of course, those lifetime transfers. Now then, IHT, of course, like any tax, has to be paid by a certain person by a certain date. A little bit of admin. Let's just give you that now in relation to what we've seen so far. Once we've computed the IHT liability, something we are still, of course, to do, it has to be paid by the so-called personal representatives, otherwise known as executors there, the personal representatives of the individual. And that must be done before they get letters of probate, which then allow the estate to be distributed. But is anyway, in the date that you have to remember, due 6 months after the end of the month in which the taxpayer died. 6 months after the end of the month in which the taxpayer died. So if the taxpayer died in June 2019, then in relation to that chargeable estate of yours, the personal representatives would have to make the payment of IHT by that latest date, 6 months after the end of the month in which the death occurred. The death occurred in June. 6 months after the end of June, June 30th, will be the end of December, December 31st, 2019. Now, of course, we always think that you would delay paying your tax until the very last moment. Why give to HMRC the cash, the tax, before it is due? Well, there's a very good reason here why you would want to settle that liability. I say you, why the personal representatives on behalf of the beneficiaries there would wish to settle that liability. Because until that tax has been paid, the assets held within the estate of the sadly deceased taxpayer stay in that estate. They are not yet distributed to become the assets of the beneficiaries. The beneficiaries, no doubt, keen, therefore, to get their hands on the value of those assets. That ain't going to happen until such time as the tax has been paid. If they simply ask you for the due date, of course, for tax payable as a result of the death of the taxpayer, that's going to be 6 months after the end of the month in which the death occurred. Now, we've said there it's paid by the personal representatives. Now, of course, they're not paying with their money. That money in relation to the chargeable estate at death is coming out of the estate. They will take the money out of the estate and pay the tax. So it means that although the personal representatives pay it, it ain't their money, it is coming from the estate, an estate that otherwise would then have gone intact to the beneficiaries. So it is the beneficiaries that suffer the cost of that IHT, because the value of the estate to be distributed to them is now diminished by the amount of that IHT. And when we say the beneficiaries, it is usually suffered by one specific beneficiary. And here we've got a lovely term here, usually the residuary legatee of the estate. A legatee, someone who receives a legacy, a beneficiary there of the estate. The residuary legatee, the person receiving the balance of the estate after any other specific legacies have been paid out. Now, estates are not always set up in this way. What you might simply say is that I leave my estate to my 2, 3, 4, 5, however many children you may have there. You just leave it to your kids. In which case, therefore, the tax is paid by the personal representatives out of the estate, and then that value is split equally between those beneficiaries. They've all suffered an equal amount. But what we sometimes have is an estate whereby you say that I've got specific legacies that I want to go to these individuals. I want A to have £40,000. I want V to have £30,000. I want F to have £20,000. And I want C to have my prized possession, my set of Aston Villa football programmes. They're clearly worth a huge amount of money. Now, all of those specific legacies, they go to those beneficiaries free of any tax. So A gets the 40,000 there, V gets the 30,000, F gets the 20,000, C gets the prize set of Aston Villa football programmes without any chargeability to tax. What it means is that then the rest of the estate goes to this so-called residuary legatee. So I leave these specific legacies to A, V, F, C. The residue of the estate goes to X. The residue of the estate goes to X there. X is the residuary legatee. So what is left over after any IHT has been paid out of that estate, that then goes to the residuary legatee. They, the residuary legatee, have effectively suffered the cost of that tax. All we normally have to do is to say who pays it and by what date it will be paid there. Okay, so we have got these hugely valuable nil rate bands, the normal nil rate band and the residence nil rate band there. 325,000 in relation to the nil rate band and up to 150,000 in 2019-20 tax year anyway in relation to the residence nil rate band. Okay, let's move on therefore and have a little look at illustration 2. Now then, in terms of illustration 2, well, you know what, you just have a little read through that. There's not much to read, both the requirement, of course, and the information. Don't look at the answer, and I'll briefly and quickly take you through that. So just pause for a moment while you do that. Okay, let's see what we have here. We've got to compute the IHT liability arising as a result of, sadly, D's death. Again, of course, in our illustration, the humorously named D parted there. The spinster, which simply means never married, died on the 1st of February 2021, leaving an estate valued at 0.75 million. Now, again, in the exam question, if it was a section B question, of course, where you're going to have 10 marks, 5 2-mark exercises there, you may very well have to firstly work out what the value of that chargeable estate may be. Again, listing out those assets, applying where relevant the valuation rules, taking out those debts and liabilities due at the date of death. But we're given that figure here, 0.75 million. And that included her, and there's the expression, main residence. As soon as you see main residence, you are thinking about the availability of the residence nil rate band. And that was valued at 0.4 million. Now, obviously, in getting that figure within the estate, we would already have deducted any mortgages there from that value of the property. So that would be the net value after the deduction of the relevant mortgages that are to be deducted for inclusion within the death estate. Now, of course, given that that is 0.4 million, £400,000, that, of course, is bigger than the residence nil rate band, so you know you'd be looking, if applicable, at a maximum of £150,000. She has made no chargeable transfers of value in her lifetime. So when a taxpayer dies, we are thinking in terms of, and this will become automatic in your heads, I trust, eventually, is that we're thinking, firstly, as a result of death, we have to look at lifetime transfers made within the 7 years of the date of death. Deal with each of those chronologically, like we said, 6 years ago, 4 years ago, 2 years ago. Lots more practice on that, by the way, in our next lecture together, coming up soon. We would have applied the nil rate band firstly to those lifetime transfers. Well, here, there weren't any. So it means that the nil rate band is fully available in relation to the chargeable estate at death. She's now bequeathed her estate to be split equally between her nieces and nephews. And here, of course, we now see the problem as regards the residence nil rate band. It's not available, of course, because we are not leaving the main residence to a direct descendant. And there we've got that note to that effect. The residence nil rate band not available as the main residence was not left to a direct descendant. So the only nil rate band we've got is the normal nil rate band of £325,000. So then becomes a simple exercise that we have a chargeable estate already given equal to £750,000 there. The net assets were 750. That is net. We've already deducted, of course, the amount of debts and liabilities. So our chargeable estate is 750. None of the 325 nil rate band has as yet been used. So the first 325 is at nil. Out of 750, that therefore leaves a balance of 425,000 to be taxed at 40% there. Again, that huge increase from nil to 40%. And all being well, if my arithmetic is correct, that comes to £170,000. Now, in this particular exercise, they ask you also then to say, as part of the answer, state the date by which the liability should be paid. Our hero here, D, died on the 1st of February 2021, so 6 months after the end of the month in which the death occurred. So we'll have a requirement to pay that liability of 170 by the 31st of August 2021, as we said, 6 months after the end of the month in which the taxpayer died. Now, we didn't here, of course, specify who had to pay it, but it is the personal representatives, and we have not been told to say who suffers the tax, but the tax will come out of the estate and hence is borne by the nieces and nephews. They are the residuary legatees. There are no specific legacies with a residue to the residuary legatee or legatees. There is just, I leave my estate to these people, in which case they will suffer on an equal basis, of course, their share of the IHT burden. Now, there was no residence nil rate band. Let's just finish this particular lecture with an inclusion of that nil rate band. If you now go back to illustration 2, which of course we've just seen there, the value of the estate, the net asset, the chargeable estate value, £750,000, including a main residence that was to the value of 400. But now, let's assume she was married at the date of death and left her entire estate to her children. Then, as her main residence was left to direct descendants, the residence nil rate band would apply, so that the IHT would now be computed as we would have both the 150,000 nil rate band, residence nil rate band. Remember why the full 150 was available. The net value of the property was bigger than that at 400,000. So we get the full 150. There were no lifetime transfers made within the 7 years of the date of death, so the full nil rate band. So in total now, we've got some 475,000 of nil rate bands to use up there. Obviously, that 150 is specific to that particular main residence. But that reduces the balance of your 750,000 to be charged to tax at the 40% rate down to 275. which hopefully, when taxed at 40%, gives us £110,000. Okay, enough for this particular session. Go back over this before, again, you move to the next session, remembering what we said about if you had several lifetime transfers made within the 7 years of the date of the death of the taxpayer, then those lifetime transfers, going from earliest in time terms chronologically, the one furthest from the date of death, through to the one closest to the date of death, there we apply the nil rate band chronologically, first come, first served. Using up the 325, after the 325 has been used, we then revert to a 40% rate of tax. Okay, we'll call that a day. Next time, as I said, we will look at examples dealing with that series of lifetime transfers and then the balance of chargeable estate still to be taxed after those lifetime transfers.